So I was talking about this example of payments. Deficit country making a payment to the surplus country, the foreign exchange dealers of these two different kinds facilitating that. I didn't specify very much about these foreign exchange dealers. Now I'm going to say a little more about them, okay? Are these private banks or are they central banks? Are these private dealers, speculators or something, okay? Or are they entities of the state? Okay. Well, that's exactly where the rubber hits the road. It depends. That's the point. It depends. Remember I showed you at the beginning the hierarchy of money. Okay. If you're talking about the dollar market, okay, there's a huge amount of private foreign exchange dealers that are operating, okay, looking to make, and they're highly liquid, very thin margins. If you're talking about Hungarian forints and so forth, you're talking about the central bank, okay? There's not a deep and liquid market here. So this hierarchy of money has to do with the relationship between government bank and bankers bank, okay? In some currencies, most of the action is bankers bank. In other currencies, most of the action is central bank. The weaker currencies, it's all about central bank, okay? The stronger currencies, there's a deep and liquid private market for these. So the essence of our story about exchange rates, okay, as we go forward, I'm not going to do it today, we're done for today. The essence of our story about exchange rates is going to have to be about the relationship between the private, profit-seeking foreign exchange dealers and the public, welfare-seeking central bank. I don't mean to say that central banks are the good guys and these are the bad guys. In fact, often it's the reverse. In many countries, the central banks are the agent of some rapacious dictator or something, and they're the bad guys, and the private profit-seeking are the good guys. They're saying, we're not going to do business with you. So I don't mean that. I'm just saying that we need to appreciate that this relationship is going to have many different forms as we go through the hierarchy. Okay? That in some cases, when you want to understand the determination of the exchange rate, you really just got to look at the central bank, and that means it's all politics. Okay? Or a lot of it's politics. And in other cases, the central bank is just a dealer of last resort. They're sort of in the wings, okay, that in case there's problems that develop in the private market, they will step in, but usually they don't. Okay? So we're going to have to understand, what are these outside spread? Where does the outside spread come from that the dealer is giving in the foreign exchange market? Okay? We saw it clearly with the gold points. You could see that. But in the modern economy, there's not gold points. So what's the analog to the outside spread? We're going to see that there is one. Okay? And that central banks in pegging, in controlling short-term interest rates are in effect creating an outside spread for the foreign exchange market. Okay? We're going to see that. So we're going to be able to use our dealers market again. Okay. It's foreign exchange is more mind-blowing, I think, than just normal money markets, because you have to know about normal money markets first. Okay. You have to know all of that and have absorbed all of that, because all of that is happening in one country and all of that's happening in another country, and there's a whole set of dealers in between as well. Okay. So it's quite a sophisticated thing. I think you're ready for it. You know, that's the whole job of this course, was to get you ready for it, okay, by now. But you can appreciate why it is that often economists and finance professors want to simplify and say, let's just forget about all of that, okay, and just say it's the relative price of assets or it's the relative price of goods, and we don't have to pay attention to all of these complicated things. And I know it's $4 trillion worth of a daily flow, okay, but I'm not really sure why they're doing all that. It must be a waste or something, okay. Well, once you realize all these transactions I mean, it's so typically the case. To make $10 trade, there's all these other little trades below the line, okay? So there's a lot of foreign exchange movement, okay, in order to separate this risk into different categories and put it in the right place, and there's a lot of trading. But it's nowadays it's electronic, and so it doesn't actually cost very much. So there's a lot of positioning without necessarily burning up a lot of real resources.